Okay. So capital investments, it is nothing but you are investing your money and you are going to start some project, some business, some activity. Okay. So for that, investment is nothing but you are putting your monetary resources into some activity from which you want to earn profits. That is what is nothing but investment. And when you put your whenever you invest your money into any of the activity for generating profits, that investment what you make for the first time is called as capital. Okay, so capital investments are nothing but the money what you put into certain activity to generate revenues, returns, profits, or whatever you want to say, gain, etc. And then capital allocation. What is allocation? You are you have $1 million. Let's say you have $10 million. So how are you going to, like $5 million I'm allocating for EV vehicle manufacturing out of this $10 million. So this is called allocation. That means setting aside money for certain particular purpose or for some specific purpose, and putting that money for that specific, putting that money into that specific activity is capital allocation. See, a project, let's say you are going to start a project, and the project is going to be a EV manufacturing project. So in this EV manufacturing project, let's say you want $10 million. Out of this $1 million you are putting only for R&D, research and development. So this is called allocation. So setting aside certain amount for certain specific purpose is capital allocation. Investment is for earning profits. The project what you're going to start would definitely require $10 million investment, but out of this $10 million, $1 million has been allocated or assigned for research and development. That's called allocation. Okay, let's go ahead. Describe types of capital investments. So first and foremost, you can put your money into going concern projects. That means the projects which are not going to stop or not going to run on seasonal basis. Those are not, that means you're putting your money into certain business which is not going to stop, which is going to run forever for a long period of time, and there is no disruption in that kind of business. And every year you may be producing goods, selling goods, generating revenues, reducing deducting your expenses out of it and trying to earn certain profits. And then again next year the same thing goes on, goes on and on and on. Okay, that is going concern project. If I say seasonal project, it's only for 6 months, not forever. Okay, so going concern projects may be needed to maintain the business or reduce costs. Projects that maintain the business do not require detailed analysis. That means there are certain projects which are very important to run to maintain the business activity. So you don't require a very detailed analysis for that, because those are definitely to those projects are always supposed to run. Okay, for that you need not do careful, detailed, or all any kind of analysis, because those are something which are the backbone of the business. Those has to run. For example, for a production company, the production should always happen no matter what. So the only issues are whether the existing operation should continue. That means the only problem at times comes is whatever the businesses you're running, let's say a company A has 3 subsidiaries. This is the parent. That means it has three different segments. Segment A, segment X, Y, Z. Out of this, X is not doing well. That means this is running into losses. So they can think of shutting down this business, right? Then the going concern status of this would not be existing. That's what. That's what you are looking here. If there are certain existing operations, whether they should continue, and if so, whether existing procedures or processes should be maintained. Projects to improve efficiency may be projects to improve efficiency may involve determining if equipment that is obsolete but still usable should be replaced. So what they are saying, going concern, the question here is about going concern, whether the things what you are having right now to run your activity, to run your project should continue with you, or you need to replace them, or you need to buy new one, or you need to sell the existing business or existing plant and machinery, or any of the asset which is very important for your project. That is what the question is all about. So to reduce financing risk, companies often use a match funding approach. Match funding. Financing projects with capital resources that are consistent with the project life. Analysts often use a company's annual depreciation expense as an estimate of capital investment it needs for going concern projects. So what they do, analysts often use a company. So what are they saying? Match funding. That means they, whatever the funding you are going to do in your business, you're going to, match that funding, or let's say, matching concept, right? You're matching your expenses with the incomes, right? So what they are doing, they are funding or investing money in the project. With that, they are buying some capital equipments like machinery. They are using this machinery, and every year they are reducing the value of this machinery with some estimate that is called depreciation expense or depreciation. Because with the passage of time, the machine value has to be depreciated because of the wear and tear, usage of that machinery, because of the technology becoming obsolete in the coming future, etc. And one fine day this machine will become zero. Okay, so that's what. Now next are regulatory compliance projects. So what is regulatory compliance projects? This may be required by a government agency or insurance company and often involve safety related or environmental concerns. These projects typically generate little to no revenue and require the company to evaluate alternative ways of carrying out projects. So see, regulatory or compliance project are nothing but these are the projects which government does. Okay, let's say government is spending some good amount of money for environment purposes, and government is spending some good amount of money, and they are, let's say the government has come out with the insurance company, which is a government funded insurance company. So in this insurance company, they want to give insurance to health insurance to various poor people in our country, so that the poor people who cannot afford medical aid can definitely get insured themselves with this government's insurance company, and the premiums are going to be very less or subsidized premiums maybe. So these kind of projects taken up by the government for the benefit and for the safety of the people can also be a capital investment project. Expansion projects, that means the company wants to expand itself. They want to start a new product line. They want to expand by opening or setting up a plant in some geographical location, etc. Or they want to go for acquisitions, mergers. So anything is possible for expansion. Okay, and other projects such as new investments outside a company's existing line. Let's say Tata is into vehicle manufacturing, automobile manufacturing, and they want to invest into cosmetics. Now what is the relation between cosmetics and automobile manufacturing? We can't establish or can't see any relationship between them. This is a separate line of business. This is a separate line of business. But Tata wants to foray into this. That means they want to enter into this market. Because Tata happens to be a conglomerate. Conglomerate is nothing but a group which is having multiple businesses, okay, or in different lines. Or you can go for any startups. You can start a startup, okay, with a business idea. So these are the types of projects which you can take up, put your money as an investment into it. Either you can put it, either you can arrange the money from different sources, okay, and go ahead with the projects. Now, next question, describe the capital allocation process. That means the money which you want to use for a specific purpose. Calculate net present value, IRR, and ROIC, return on invested capital. So let's now enter into the subject deeply. What is this all about? Let's say there are, I will explain you how to calculate NPV, okay, with a small example. Already you know what is compounding, what is discounting, what is time value of money, etc. So I'll not be going into those basics. I'll be directly starting the topic here. So let's say there is a company, there is a Tata wants to start a new project, and the project is to invest in a EV manufacturing or a project into EV manufacturing, and Tata wants to the project is EV manufacturing, and that too EV bike manufacturing. Tata is into EV car manufacturing, but Tata is not into EV bike manufacturing. Tata wants to enter into this segment, okay, and they are considering two different, geographical locations. One is Zahirabad in Telangana. Let's say this is mutually exclusive projects. Mutually exclusive project. Mutually exclusive project means only one out of two can be selected. If one is selected, the another one cannot be selected. That is understood fact. There can be many reasons for that. Maybe capital constraint, or they don't have that much of capital to fund or start two companies in two different geographical locations. Okay. Zahirabad in Telangana. Zahirabad has NIMS. It has been declared as NIMS, National Industrial Manufacturing Zone. And then there is Chennai. Chennai is known as Detroit of South Asia. Detroit is a famous city in United States which was known for car manufacturing. It was the car manufacturing hub of the United States in 18th or 19th century. Almost every car company in the world had their factory in Detroit, and they used to manufacture there because the talent pool and the skills what were required to manufacture automobiles was always available or present in Detroit. And Chennai has got that kind of, that kind of fame in South Asia. It is compared with the likes of Detroit, and why not? Chennai is also a port city, and port cities are the ones which reduce the transportation cost, because the if you see, the vehicle are manufactured in Zahirabad and then they are transported to a port like Vizag or Chennai. Even the port should be having that capacity to hold such kind of stockpile of such big size. So that kind of port Chennai is. Vizag, maybe Vizag is also a big port, let's say. So from Hyderabad, from Zahirabad, the consignment has to move to Vizag, and from Vizag it has to go through shipment to different countries. That is going to cost a lot for the company, right? But Chennai, directly you manufacture there, and directly it is already a port city, so you have very less transportation cost in this case. So what happens? This has lot of advantages, and Zahirabad also has got some good advantages because government subsidized lands to companies to manufacture their vehicles in Zahirabad. Even Chennai also is giving, around Chennai also, government of Tamil Nadu is giving certain good subsidized lands and some good uh, facilities for the EV manufacturers to attract them to invest and start manufacturing. So both are good projects, but we have to select or pick out of the two. Positive NPV is the one which we are going to pick up. So how to find out that positive NPV? What is that going to be? We'll see right now. Okay, give me a second time. I'll be back. Give me a second time. So here mutually exclusive projects we are taking up. So let's say the investment in Zahirabad plant is $100,000 and in Chennai Detroit is also $100,000. Let's say the cash flows in this project are 10,000, 20,000, $30,000. These are all imaginary figures. $40,000, $50,000. Okay. And in the Detroit, Chennai, the project what we have taken up, the the cash flows are $10,000, $5,000, $1,000, $20,000, $30,000. The rate of return from both the projects what we are expecting is 10%. So this is the rate of return. We are going to discount all this future cash flows with this 10%. We are going to discount all this future cash flows with 10%. So now discounting, why we are discounting? Because we know time value of money. The time value of money is such like the future cash flows what we are seeing here 1, 2, 3, 4, 5. These all future cash flows have to be converted to present values, because this future cash flows what we are seeing are futures money. Today the value of 10,000 is not the same 10,000 what it is after 1 year. Okay, and the time period here I am putting as 1, 2, 3, 4, 5. These are the time periods for 1 year, 2 year, 3 years, 4 years, 5 years. So now the cash flow what you are going to get at the end of the first year, which is 10,000, is not going to be the same as on today. What we are going to get 20,000 after 2 years is not going to be the same as on today. This is the zeroth period, that is Jan 1st, 2024. So what you are going to expect at the end of the first year is not going to be the same as on today, that is on Jan 1st. What you are going to get at the end of the second year is not going to be the same as on today. That means the value of 20,000 is going to be different today than what you are going to see, that 20,000, what you are going to get that 20,000 at the end of the second year. So what is the value of 10,000 as on today? What is the value of 20,000 as on today? What is the value of 30,000 as on today? What the discount factor or what the required rate of return what we are expecting is 10%. That means if I invest this 10,000 as on to, if I invest some X amount as on today, it's going to become 10,000 at the end of the first year. So what is that X amount I have to invest to get that 10,000 at the end of the first year, and the rate of return what I'm expecting is 10%. So for that we know like we have to find out the present value of this. So let's say that present value is the X amount what we are getting. So this is the amount which if we are investing at the rate of 10%, okay, for 1 year we are going to get 10,000. Okay, so what is that amount we are going to find? For that we will take up the discount factors. Discount factors at the rate of 10%. So what is the discount factor at the rate of 10%? 0.9090. 0.8261. We'll just give me a second, we'll calculate. These are the discount factors. We will multiply the cash flows and write it here. Discounted cash flows. So 9090, the next one is 20,000 into 0.8264, 16,528. 30,000 into 0.7513, 22,539. 40,000 into 6830, 27,320. 50,000 into 0.6209. So now we will add up all these values. We are getting 1,06,522. This is the present value of future cash flows. Okay. So now to find out NPV of a project, the present value of future cash flows minus cash outflow. So the present value of future cash inflow is 1,06,522 and the outflow is 100,000. So you're getting $6,522. This is your like difference what you're getting, and this difference is a positive difference. So this is positive NPV. Okay, positive NPV. So Zahirabad project is giving us positive NPV and we can consider Zahirabad project. Let's see the Detroit, the Chennai project, how much it is giving to us. So we will write down the cash flows here. So so first is 10,000. 10,000 into 0.9090 is 9090. And second one 5,000. 5,000 into 0.8264 is 4132. 1,000 into 7.513. 0.7513. 751. 20,000 into 0.6830. 13,660. What I'm doing is I'm multiplying these factors with these cash flows. Okay, and these are the cash flows for this one. I know I'm not, this is not that neat, but please try to follow up while you look at the video. This is this cash flows present values, and these are the this cash flows present values. Just add all these cash flows. we are getting 46,260. So NPV. Present value of cash inflows is 46,260 and what we have invested is 100,000. So you are getting a negative NPV and you can understand when you get negative NPV of 53,740. Okay, negative value, and you have to reject this project because you can only take positive NPV projects. Okay, so this is the concept of NPV. Let's go and do a question from textbook. Hopefully all of you understood this concept. Please tell. Hello.
Yes, sir.
Yeah, I'm asking to everyone. Hopefully you got this concept, right? If
Sir,
not, you
how
can.
do we,
Yes.
hello? So how do we calculate NPV in the BA calculator?
I'm coming to that. Okay.
Okay.
It's a lengthy procedure. We will do that. Just do this question and tell me what's the answer, all of you. The question is in front of you. Fast. Yes, I'm just waiting.
But 22 point something it's coming.
22 point something. Okay, let's see. So what you have done, $100 in the beginning, 0th period. This is the investment what you have done. First year, second year, third year. The cost of capital is 9%. So the cash inflows what you have got is 25, 50 and 75. That's what they have taken. And the discount factor is like 9%. So you know, present value is equal to future value by 1 plus r whole power n. That's the formula. So your future value is 25 for the first year. Divide by 1 plus what is the cost of capital? 9%, 0.09 whole power 1. So that is 25 by 1.09. Second year, cash flow is 50. 50 by 1 plus 0.09 whole square. So it is 50 by 1.09 whole square, right? Same thing. And then third year it is 75 by 1 plus 0.09 whole cube. 75 by 1.09 whole cube. That is the third one. So we can do in this way also, or else we can do in this way also. The value of, so this can also written as 25 into 1 by 1.09. That also is nothing but equal to 25 by 1.09 plus 50 into 1 by 1.09 whole square plus 75 into 1 by 1.09 whole cube. So this the value of this, the value of this, and the value of this is what we can write it here. Discount factors at the rate of 9%. Multiply the values, discounted cash flows. Now you have to multiply these three. You have to add all these three values. And the investment is 100. So NPV would be 122.9855 minus 100. 22.98 is the answer. It's almost nearby. Okay. So if you just do this way, 25 into 1.09, the value is 0.9714 for this. The value for this is 0.8416. The value for this is 0.7721. If you multiply, you will get the same answer. Okay. So the NPV is 22.93. You can do that with the help of TA, BA plus calculator as well. Take out your calculator, all of you, and follow this instruction. First CF, second clear work. If you don't have, you can download the app. So first CF, click the CF button in your calculator. Okay. Second clear work. Okay. Then you have to enter 100 plus or minus. Then enter. Okay. That is the initial cash outlay. That is what you are seeing here. Then you have to click down arrow. And then you have to click 25. And then you have to click enter. And then again down arrow. Again down arrow. Then 50. Then click enter. Again down arrow. Again down arrow, then click 75, then click enter. Again down arrow, then click NPV, then click 9, and then click enter, then click down arrow, then click compute. You will get 22.9335. Please do this. I have already got. I can share the screenshot with you all people. Are you following this instruction? Hello? Hello?
Yes, sir.
Yes, I got the
Yeah.
answer.
Yeah, you will get the answer surely. Okay. Once you can try once again, we'll move forward. Yeah, yeah, good. Yes, if done, shall we go ahead? Okay. Now, next concept is IRR, internal rate of return. Okay, what is this? I'll just give the statement to you and try to explain the concept. IRR, the cost of capital, which is also called as required rate of return, at which cost of capital or expected return or discount factor all mean the same. So the cost of capital or expected return or discount factor at which the NPV of the project is exactly equal to 0 is called the IRR of the project. Now, many of you may have not understood what I mean to say. So let's do this same question here, what we did, the Zahirabad one. Let's say we have this cash flows and we have the expected return, what we are expecting from this project is 10%. And we have this discounted cash flows. Let's say we have got, okay, I'll do a fresh question for you, no problem. So the project is like, 10,000 you're investing. First year you're expecting 5,000. Second year you're expecting 10,000. Third year expecting 15,000 as the cash flows. This is 0th period 1, 2, 3. And the discount factor is 10%. That is the expected return we are expecting from this project X. Okay. Now, 0.9090, 0.8264. 0.7513. Add all this. So I'm getting 24,078. Okay. Definitely my NPV is 24,078 minus 10,000. 14,078 positive NPV. So if I, so this is at 10%, am I getting zero NPV? No, I'm not getting. Since I'm not getting zero NPV at 10%, 10% cannot be my IRR. So what is my IRR, or the rate at which my NPV of this project will be zero? I will take a higher discount factor. I'll take 20%. Okay. Discount factor is 20% now, discount factor. So the discount, the discounted values are 0.8333, 0.6944, 0.5787. Now we'll multiply these cash flows with this. So 5,000 into 0.8333. So you get 4166. Then 10,000 into 0.6944. So 6944. So still there is not a scope of getting that. I will take 30% as my discount factor then now. This was 20% because I'm not going to get zero NPV. So 1 by 0.7692. I think I have to take very high discount factors. Let's say okay, let's do one thing. Let's not take this. Let's take the textbook question what they have given. I think you have understood the concept clearly. What I want to prove you. Let us see this. I'll exactly prove you what is IRR. Here there is a project whose cash flows are given. So that is 25, 50, 75. And the investment is 100. Let's say my capital is 19%. Okay. Discount factor. So we'll try to discount all this cash flows at 19%. We'll multiply these values. I'm writing here 21. So let's add all these values. I'm exactly getting 100. This is my present value of future cash flows. So my NPV is nothing but present value of future cash flows, which is 100 minus the investment what I've put, that is 100, and I'm getting zero NPV. When I get zero NPV, I'm getting this zero NPV at what rate? 19%. So what is my IRR? 19%. Did you understand this one? Please tell me yes or no. Hello.
Yes, sir.
Yes, all of you. Yes, fine. Yes. So let us stop the concept today. Let's continue tomorrow. I'll close this chapter tomorrow. Okay. Thank you all.